Hi there, it's me, Stephen Thomas, with yet another housing debrief. So this week was a huge week. Before we get into the actual housing debrief episode, I wanted to go over what happened this week because it was an extremely important week as far as rates are concerned. And it's jobs week. Happens the initial week of every month. And so this was a big week. It started off really positive with job openings, and job openings were lower than expectations, went all the way down from 8.5 million job openings to 8 million job openings. And this means that the job market's just getting a little tighter. This was good news, and we saw a big reaction in rates. Rates dropped for the day. It shows that the overstimulated, over-hot, robust jobs market is starting to cool a little bit. It kind of needs to because there were way too many job openings, way too few people looking for jobs, and that puts pressure on inflation. So this was going into better balance, and we saw this jobs report come out with job openings. It was absolutely fantastic. So this was at the towards the beginning of the week, and then along came today. Today is Friday, and we had our May jobs report came out, and it was supposed to be at about 180,000 jobs created. Instead, 272,000 jobs created. So now remember, this is backwards looking. This is looking at the month of May. It's not quite where we're at right now, and there are other headwinds, but this is very focused on this most recent report of 272,000. Should have been around a 180. So because of this report, we had interest rates bounce back up. We had interest rates that were almost going to make their way underneath of 7%. But this report, as a result, we have rates that are higher. They're now back up into these sevens, a little bit above 7.1%. So finally thought that the housing market was going to get a break. We're going to get interest rates down. But unfortunately, it didn't work out that way. You never know with the numbers. Now, unemployment actually has gone from 3.8 to 3.9 to 4.0. So this was a bit of surprise. Unemployment is continuing to rise. So this is not the perfect report. It still shows a robust jobs market. However, there are definitely some headwinds that we have to calibrate and understand and look at the trends going forward rather than be so geared towards looking behind us. That's not what we want to do. And unfortunately, I think that the Fed is kind of putting themselves in that position. We'll have to see where they go from here. They're definitely not going to be doing a rate cut in June or July. It's now looking a lot like September. There'll be a lot more data that's going to unfold over the coming months prior to September coming along. So we have to stay tuned. And so this week, we're going to get into foreclosures, a big foreclosure update. Wanted to do this foreclosure update because it's still surprising to hear the number of people that are waiting for this market to crash. And it's not going to crash, and values aren't going to plummet like so many people think. You got to take a look at this purchase application index, kind of understand where things have been in the past. This is the purchase number of purchase applications across the United States done by Mortgage Bankers Association. Calculated risk creates this particular chart. And you could see that prior to the Great Recession, that credit was just so easy. Everybody was getting a loan, and it was going through the roof all the way until we got up to right before everything totally began to unfold for the Great Recession. But you can see how it was all built on everybody could qualify, easy to qualify, versus what happened on the right-hand side. You could see that credit was just unfolding where it was getting more and more people were applying, but this was as demographics were changing, as the economy was continuing to improve, slowly but surely we got more mortgage purchase applications. Way different than prior to the Great Recession. And so what we're doing is I'm showing you the difference between up at the top, you could see where too many people were actually applying for mortgages. And on the right-hand side, there are a lot fewer people applying for applications, and I'm going to show you these two different circles when it comes to the areas of mortgage originations by credit score. This is super important to just hone in on. That's why I'm zooming it in for you. And you'll see on the left-hand side and the right-hand side, big difference. Those different colored bars, the light blue one that you can see on the right-hand side, which most of all the purchase applications are made up of those kind of qualified borrowers, they have credit scores of 760 plus. Now, the darker gray is 720 to 759, and then you start to get in trouble when you get to 660 to 719, and then below that, the blue is 620 to 659 credit scores, and the dark blue is less than 620. So you could see that prior to the Great Recession, that big buildup was made up of a lot of people that did not have excellent credit. There were very few people that had excellent credit. You flash forward to post Great Recession, and especially over the last many years, you could see that pretty much the mortgages were made up of borrowers that had very strong credit scores. And pointing out further, you could see that the weakest credit patch, less than 620, extremely vulnerable. Back on the left-hand side, you could see how many people actually got mortgages. And a lot of these people did zero down, they did adjustable rate mortgages, and they did not have a lot of skin in the game. You look on the right-hand side, and pretty much most everybody had to put down a considerable down payment in order to purchase a home and compete with everybody else. So even though there are people that are getting these loans, it makes up a really small number on the right-hand side because they have to be able to have a down payment besides having their poor credit score. So it's very few of the borrowers on the right-hand side are where we have credit risk and credit problems. And you can actually see this. I'm going to show you in the various counties that we track at Reports on Housing. Really easy to see. On the left-hand side, we have a lot of people that purchased homes with mortgages that they really couldn't afford, and they had poor credit, very little down payments, and it just set up this disaster that occurred during the Great Recession. And these are the number of closed distressed sales. Now, if you look at it, it got up to over 6,000 during the Great Recession. And that is short sales and foreclosures, the numbers that actually closed on a monthly basis in Maricopa County. And on the right-hand side, you can't even see it. The number of closed sales, there are some, it's just so few compared to the 6,000 when you're only talking a few, like a handful, 5, 10 foreclosures and short sales combined. And this is true from market to market. This is Clark County. You zoom in on Clark County and you actually see that it got up to nearly 4,000 during the Great Recession. And on the right-hand side, very few closed distressed sales. And in Southern California as a whole, you could see that there were a lot of foreclosures, over 10,000 foreclosures in 2009. And you look on the right-hand side, this is Los Angeles, San Diego, Orange County, Riverside, San Bernardino, all combined, very few foreclosures that are actually closing on a monthly basis. And then you get the Bay Area, again, very few on the right-hand side versus the left-hand side where it made its way up to 4,000 foreclosures for all 9 counties in the Bay Area. And you wonder, where are we at right now in terms of delinquencies? And you look on the right-hand side, we're at a very low, decades low, as far as where the national delinquency rate is at 3.09%. Now, 2000 to 2005, prior to the Great Recession, the average was 4.05%. So you can actually see delinquencies is way less at 3.09%, and you go all the way back for decades to get to these are decades lows since they've been tracking these numbers. And in looking across, that is exactly what is happening, that it is at a very low threshold. Even where we were prior to setting up the Great Recession, it is at decades lows. And you could see that with the credit profiles of all the borrowers, all the people that have been purchasing homes since the Great Recession have all had to qualify, and they've all all had excellent FICO scores. And when the markets got extremely lean and we had fewer and fewer homes available and a lot of buyers competing, the ones that actually won, it's like survival of the fittest. It's Darwinism. And what you have are this demographic patch of homeowners, all these homeowners combined. Who was winning? It was people with strong credit scores, with considerable down payments. Or all cash was winning, because we're looking at the number of people that are actually that are with the Mortgage Bankers Association, that they're tracking the number of people that are actually looking for loans. There's a lot of people that are paying all cash for homes, and it's been going on for several years as well. So where are the issues in the economy? Now, if you look at this is, and I downloaded the series. This is from the New York Federal Reserve. There are issues that are out there, but you have to look at all the different kind of credit. There's automobile, there's credit card, there's mortgage, there's HELOC, and those are and student loans. You can see at the bottom right-hand side, you can see where we are right now today. That is mortgages. It's slightly rising, but we're not even close to where we were prior to the pandemic. There are HELOCs. HELOCs also not where we were prior to the pandemic. And student loans dropped off the face of the earth. The delinquencies are way off. And a lot of that has to do with a lot of them they didn't have to make their payment for a while. And there was a lot that went into that coming down as sharply as it did. Now, where are the actual issues? It's not in the housing arena. This is coming from outside of the housing arena. And it's most likely, when you look at the credit profiles of these people, it's the people from the middle class on down, and it's not really the homeowner patch that is being affected by this. It's renters from middle class on down, and you could see it here with this right here. I'm actually showing you where we are as far as loans are concerned. And then this right now, this is the difference where we are right now as far as credit card transition to serious delinquencies. Those are the people that are becoming seriously delinquent 90 days plus. And you can see it's at the start of 2008 is where we are with credit card delinquencies. Now, that doesn't mean we're going into the Great Recession. I've already explained that all the homeowners combined are extremely strong with excellent credit and big, considerable down payments, a lot of equity in their homes. A lot of people that are equity rich have 50% plus equity in their homes. So there's not going to be a lot of short sales or foreclosures based upon looking at credit card debt. But what this is these are headwinds that are going to cause the overall economy to slow, because credit card debt is ballooning with 22% interest rates. It is at the highest level that it's increasing like crazy going back to January 2008. And this other line, this here, I'm pointing to automobile serious delinquency, that transition. And you can see where are we at right now. It too has gone up, and it is the first quarter of 2008. So it's further along. I think it's about March of 2008 is where it's at. So just another sign that it's another headwind that we have. People that are out there that are getting into a pickle. Now, they're not getting into a pickle with their homes. There are people out there that are getting pickle with putting everything on plastic, and also with their automobile debt. So those are the areas that are having a problem. It's not going to happen. We're not going to see a bunch of foreclosures or short sales. It's just not in the cards. The overall crash would have to of housing would have to come with a mass amount of supply. And prior to the Great Recession, that supply really started to grow with a lot of people that couldn't afford their monthly payments, because they qualified, and they qualified with very loosey-goosey lending standards with no down payments, and they couldn't afford their adjustable rate mortgage when it adjusted. There are not adjustable rate mortgages in the system today like there were prior to the Great Recession. So we're just not setting up any kind of a crash that would also include short sales and foreclosures. That's not going to happen. So if you want more information information, you can always go to reportsonhousing.com. If you liked what you saw today, like our channel, subscribe. We just want to get this content out to as many people as possible. The most recent report that came out is called Busting Myths. All counties have it right now. We encompass Clark County, Vegas, Maricopa, Phoenix, the Bay Area, and all of Southern California, including Ventura. And so all of them have this report this coming up week along the coast. Orange County, LA, San Diego, Ventura, they are all going to get the next report, that a new report that we are coming up with right now, and it will be coming out on Monday and Tuesday, depending upon your county. If you'd like to be a subscriber to one of our many housing reports, just utilize the coupon code BUYER when you go to reportsonhousing.com. So that's buyer. That is, I can't wait for the market to line up more in favor of the buyer. So I just keep pushing that out there. If I put that out there long enough, things will look a lot better for the buyer, I hope. Anyhow, that is another wonderful housing debrief. I really appreciate it. Thank you for tuning in. And I hope you have a great finish to your week. And we will see you on the